What's up guys, Misha here from Beyond the Huddle and welcome to another video. And today's video is going to be a little different from most of the videos that you guys have seen on this channel. We're actually going to be diving into some fundamentals today, and actually this is going to be similar to the one I did back in March of 2020 after the major COVID crash, but this time we're going to be diving a lot deeper. We're going to be taking a look at monetary policy. And I'm making this video because I know there's a lot of people right now that are confused. They don't really know what exactly is going on. They don't understand what's driving markets lower. So hopefully this video gives you a better idea of what exactly is taking place in markets right now. So we're going to break this down into a couple segments. First off, we are going to be taking a look at what were some of the main drivers of the bull market that we saw from the lows in March of 2020 all the way up to the recent highs. We're going to be taking a look at what kind of monetary policy facilitated this massive rally in Bitcoin and in most cryptos. And then we're going to be taking a look at how exactly this monetary policy is now shifting and what kind of impact this is currently having on markets. And then what we're going to do, which is going to be very important, is we're going to be taking a look back at when was the last time that we saw such a shift in monetary policy and what kind of impact that had on Bitcoin at the time. And lastly, what we're going to be taking a look at is how the asset manager position has been shifting along with that monetary policy, and what we could potentially expect next, and how we should monitor the asset manager's position to be able to identify when is going to be the best time to potentially see a bottom in this market. And obviously, I'll show you guys some of the levels that I have on my chart. So with that said, guys, I hope you guys enjoyed this video. I hope you guys get value from this. Because I know, like I said, a lot of people don't really know what's going on, so that should give you a better idea of what's going on and how you should potentially navigate through the next couple weeks or months in the market. So yeah guys, let's go ahead and let's get started. Okay, so before we get started with the content, guys, I want to make sure that I let you guys know that a lot of the information that you're going to be seeing in this video comes from this specific article right here, which is from Huobi research, and this was posted back on November 24th of 2021. And I actually came across this article, I think back in sometime in December. I came across this article and I thought it was a very useful article for people to read. So I am going to be leaving a link down below in the description, so that even after you watch this video, you can go back into this article and they go into a lot of details about what exactly is going on. So yeah, there's going to be a link down below, and I highly encourage you guys to go ahead and read that article. So now let's go ahead and actually get started with the content. Okay guys, so what were some of the main drivers of this massive bull run that we saw? In order for us to understand what these drivers were, we have to first understand where the economy was before the crash, the COVID crash, and the economy was doing very, very well. Now the crash happens, we have to shut down the economy, which then forced the Fed to have to intervene to keep things afloat. And what they were doing is they were cutting interest rates, right? They were making it easier for people to have access to money. And they cut interest rate from 1.75% all the way down to 0.25%. Now, once they got to 0.25%, they couldn't keep cutting interest rates anymore. So what they had to do was they had to resort to quantitative easing. Now, I'm pretty sure a lot of you have heard the term quantitative easing before, but probably many people don't exactly know what it means. Now, what exactly quantitative easing is, it's a way for the Fed to be able to inject liquidity into the economy without having to cut interest rates. And we can see here they couldn't really cut interest rates anymore. So they went to quantitative easing, which when they do quantitative easing, what they're exactly doing is they're buying bonds and mortgage-backed securities from the bank, which then allows the bank to lend out more money. And the banks lend out more money, that means more money circulates through the economy. So there's two things that happen through quantitative easing. The balance sheet of the Fed increases, which we can see here, right? We can see from early 2020, massive rally in the Fed's balance sheet. And we can also see that the money supply right here had massively increased. So once that happens, you also have the stimulus packages from the government, which will also injecting money into the economy. So all of that causes massive rallies in asset prices. That's why we saw real estate prices through the roof, stock market went through the roof, and crypto as well went through the roof. Now, one of the issues with all of these policies here is that it allowed for inflation to skyrocket. And if you guys know anything about inflation and the Federal Reserve, you would know that the Federal Reserve's goal is to keep inflation at around 2%. Now, what we're seeing here is nothing close to 2%. We're seeing 7% inflation, which is at a 40-year high. So now what they have to do is they have to stop this inflation, right? They can't let it get out of hand. So in order to stop inflation, what they have to do is they have to switch their monetary policy from injecting more money into the economy. Now they have to slow down that process, right? And to slow down that process, they're going to start something called taper. So we went over the fact that quantitative easing was them buying bonds and mortgage-backed securities. Now what taper is a gradual contraction of that quantitative easing, meaning they're buying less and less every single month. Okay, so that's how the Fed are going to try and tackle inflation. And then obviously they're also talking about increasing interest rates. So we would be going into an interest rate hike cycle. So this is what the Fed is moving. This is what they're moving towards. And taper actually started on November 4th. That's when they announced the launch of taper. And now what we're going to do is we're going to be taking a look at what exactly happened the last time that we saw such a monetary policy shift from the Federal Reserve, what happened to Bitcoin. So let's go ahead and let's take a look at that. Okay, so the last time we saw the Federal Reserve start tapering was in December of 2013, and that lasted all the way to October of 2014. And we can see that throughout that time, there was actually some bearish movement on Bitcoin. That was actually the 2014 bear market, right? And right now what we're seeing is a very, very similar pattern where ever since the tapering was announced, and it's not just Bitcoin, guys, the stock market's been doing it too. Assets have been declining, okay? So the question now becomes, are we going to see a continuation? Are we going to see a full-on bear market, or are we going to bounce off of current level? Now, one thing we can take a look at is a very interesting correlation between the dollar and Bitcoin. And I know that there was a member in our Discord that actually pointed that out a couple weeks ago. And if we look at that time when the Fed started tapering back in 2014, December of 2013, 2014, it's right here. And we can see that that caused a rally in the dollar. And that rally in the dollar coincides with the drop in BTC. And we can then see that once the dollar peaked right here, that's when we had the most aggressive part, right? That was the 2017 bull market. That was the most aggressive part of the bull market. And that lasted until the dollar bottomed out right here. And then the dollar started to rally and we got another bear market in crypto, which this bear market kind of lasted all the way until the dollar peaked here, which was again the bottom in Bitcoin right here. And then this entire rally in Bitcoin was matched by a massive decline in the dollar. And what are we seeing right now in the dollar? We're seeing the dollar bottomed out right here, Bitcoin tops, and the dollar rallies, and now Bitcoin is starting to decline. So very interesting correlation between the dollar and Bitcoin. And again, if the Fed is talking about going into an interest rate hike cycle, we're very likely going to see a lot of strength in the dollar, which could then mean a more downside for Bitcoin. So that's definitely something for us to keep in mind. Now, personally, I don't like trying to predict these things, right? Because I'm not an expert, right? So what I like doing is actually looking at what the experts are doing, which is looking at the COT. So if we look at the COT here, we can see that asset managers had actually been increasing their short positions ever since about October 25th, November 1st. They were very, very high already. So I'm assuming that they were doing it in anticipation of the tapering from the Fed, because although the Fed announced tapering on November 4th, a lot of people were already anticipating that the Fed were about to start doing that because of how high inflation was. So there was already an anticipation for the Fed to switch their monetary policy, which in turn would impact risk assets, including Bitcoin, the stock market, etc. So we can see that these guys were preparing themselves for this drop right here. And right now they still have very, very high shorts. Now, one thing we can notice is whenever we get massive drops like this, by the time the market bottoms out, their shorts are usually below average by that time. And we can see this happening around here. Shorts were below average once the market bottomed out. And we can even go look at what was happening at the low right here of that cycle. We can see that shorts were actually below average during that low right here. And we can see the same thing here at that low here. Shorts were below average. And we can see the same exact thing here at that low right here. Shorts below average. So you guys can see the common theme here. So personally, that's what I'm going to be looking for. I'm going to be looking for shorts to be below average before I start looking for a bottom. Now, in terms of levels, which levels I'm looking at, let's go ahead and take a look at this. I have right here different things that I'm looking at my volume profile. We can see last year, let me fix this and we'll look at the past 5 profiles. Yeah, so we can see the value area from last year, and let's hide the current profile. Right here, we can see last year's value area high, value area low, and we can see how price had actually used the value area high as resistance. And one of the targets that I had is this value area low right here. And right now we are currently inside of a weekly demand right here, which we might be able to get a bounce off of. But if we do, based on how these shorts are looking and how the Feds are switching their monetary policy, I would probably expect it to come back up to here, maybe if we do, and then potentially fall back down. So this is one of my main targets, that 2021 value area low, if we're able to break this. And another target is, if I go to my 8-hour time frame, we can see here the 2020 Q4 value area high. That's going to be another target of mine right here, along with this demand area right here. If we go to a 3-day, you guys can see there is a demand right here that kind of lines up with that Q4 value area high of 2020. And then also, if I go to a daily time frame, you guys can see this little demand area right here. So these are the levels that I'm paying attention to. I am not yet calling for price to hit those levels. I'm gonna take it level by level as always, but based on how monetary policy is shaping up right now, and also the shorts that we're seeing with the asset managers, I'm definitely paying attention for price to potentially come down into these areas. So we're looking at 29 to 30K, then we're looking at about 24K, then we're looking at 19 to 20K right here. So these are the 3 areas that I'm looking at, and also pay attention to our weekly and our monthly levels, seeing when these are actually switching, and along with the shorts of the asset managers, making sure that the shorts of the asset managers are below average, and that's when I'll be looking for this market to bottom out. So yeah, guys, that's going to be it for this video. Hopefully that clarified a lot of things for you guys. Hopefully now you guys understand what are some of the main drivers behind the drop that we're seeing in assets right now in the stock market and in crypto, and you guys have a better understanding of what quantitative easing is, why the Fed is doing it, yeah, if you guys got some value from this, make sure to give the video a thumbs up, make sure to subscribe to the channel, and also click the notification bell so you can get notified every time we drop a new video. And also, if you're interested in interacting with us, there's a link down below in the description to our Discord, which is free to join. You guys can come in, hang out with us, talk charts, talk on-chain, or whatever it is you want to talk about. And also, if you're interested in learning how we trade, we have the intro course, which is free. We also have our premium membership, where you can get access to our advanced course and our indicator suite, as you saw here with the volume profile indicator and some other indicators that we use here Beyond the Huddle. If you're interested in all of that, along with the article that I mentioned from Huobi Research, all of those links are going to be down below in the description. And with that said, guys, I will see you all in the next video. Peace.